Welcome, everyone. Good morning, good afternoon, and good evening. Thank you for joining us from around the world for our discussion about corporate debt, insolvency, restructuring, and their implications for financial stability and the global economic recovery from COVID-19. This event marks the beginning of a series of World Bank events exploring aspects of this issue that will continue over the next 2 months. We have a large audience from around the world, and we are streaming on World Bank Live, so please post your questions online, and we'll hope to respond to as many as possible towards the end of the hour. We are also live streaming on Twitter at World Bank Group Finance or at WBG Finance. Those watching can participate in the conversation and ask their questions on Twitter by using the hashtag Insolvency Series. Let me now turn the floor over to World Bank President David Malpass.
Thanks very much. And I want to welcome everybody to the discussion that we're going to have today. It'll be really exciting. Much of what has been going on in the last few years has been talk about the risks of elevated sovereign debt levels globally. There's another type of the debt burden that is going to be a big factor in the recovery, and that is the very high level of corporate debt. So we'll focus on that today. This event that we're having right now is the first in a series of World Bank Group events aimed at raising awareness of this problem, this part of the problem. IFC, which is the International Finance Corporation, the private sector arm of the World Bank Group, is going to play an important role in future discussions and will be launching the revised World Bank principles for effective insolvency and creditor-debtor regimes in coming days. So we have a set of principles coming out. We'll have more conversations like this one on this particular topic. This morning, what we're going to try to do is set the stage for the future discussions. I'm very fortunate to have two leading experts today on this, Dr. Raghu Rajan and our own World Bank Chief Economist Carmen Reinhardt. Raghu is currently the Catherine Dusak Miller Distinguished Service Professor of Finance at the University of Chicago Booth School of Business. Previously, he was governor of the Reserve Bank of India and chief economist and director of research at the IMF. He's a member of the G30, the group of 30 of eminent economic experts, and recently he led a group of 30 working group on corporate distress during the current pandemic. Carmen is World Bank Group Vice President and Chief Economist. She's studied centuries of financial crises and has published extensively on capital, sovereign debt, and corporate debt crises. And we're very fortunate to have her at the World Bank during this critical time. To frame the conversation, I'd like to share some of the stats. We're about 1 year into the pandemic. It's delivered one of the worst, or the worst setback to poverty in generations. We project in 2021 that 120 to 150 million people will be pushed into poverty. Early findings suggest that an estimated 250 million jobs have been lost around the world. The number of people affected by acute food insecurity is estimated to have doubled. We're talking nearly 300 million people by the end of 2020. On the debt front, levels of debt in the non-financial private sector were at historic highs. So that's the non-financial private sector. So that's what we're going to be talking about mostly today. By the end of 2019, total debt for listed non-financial companies in the 73 emerging markets and developing economies that we're talking about. So in developing countries, 73 of them, that total for listed non-financial companies alone reached $6 trillion. That's 60% of this debt was vulnerable to default, arising from the liquidity shocks that are rippling of the pandemic. Private domestic debt is countries stood at nearly 120% of GDP in December of 2019. And we're going to talk about whether that's gotten worse. We think it's gotten worse in terms of the real world, but not necessarily worse in terms of the recorded statistics so far. During the pandemic, many governments supported additional assistance to firms to address the liquidity constraints. So that's holding down the data as far as non-performing loans, for example. That countries did techniques such as loan guarantees, payment moratoria, and regulatory forbearance. So that was the environment in 2020. As of October 2020, the global fiscal support spending by governments was estimated at $12 trillion. And so government programs and this forbearance process for banks have, in a way, been successful in flattening the bankruptcy curve. So one could have expected a big surge in bankruptcies, but that curve has been flattened by these various efforts: the stimulus efforts, the forbearance efforts on the regulatory front, and so the data shows that many countries experienced a decline in the number of bankruptcy filings in 2020, but the decline hasn't been even, and we're concerned that it won't continue. We think the number of bankruptcies will go up. For example, the U.S. Has seen a rise in large value bankruptcies of firms at the top of value chains. So just in recent days, that's been on the front page of newspapers as those begin to occur. And evidence suggests that some insolvency proceedings are on the rise as well, especially with the larger firms. And an example of that is we think 147 companies globally with that are a greater turnover than $60 million. So relatively large companies became insolvent in 2020. That's a nearly 100% increase over the same quarter in 2019. I'm sorry, that was only for the second quarter of 2020. So you've got this 100% increase in the large company or larger company insolvencies. And research is also showing a deterioration in credit quality. So all this indicates that the risk of there's a risk of a wave of insolvencies that could trickle down and have severe consequences for small and medium-sized enterprises in 2021. Given that, so I gave you some of the background. The distress on firms is rising. So we need to think not just about the bankruptcy laws and regulations; those are important, but also of the full suite of tools that policymakers can have to facilitate restructurings for firms. What an important part of the resilience of the recovery going forward is going to be how do we facilitate these restructurings rather than end up with zombie companies that tend to go on but not be productive into the future. This might include, and we can think about, and I hope the conversations talk about how to do it. Credit enhancements is one way, such as guarantees, but also there can be informal debt restructurings and workouts that happen outside the formal court system in the legal framework. So one thing the World Bank is working on in countries is how do you have a better debt resolution process? Sometimes that's an informal process. Sometimes it can be improvements in capacity building for the formal sector bankruptcy processes that some of the countries have. So with that, Carmen and Raghu, it seems like the central question, and I want to turn to a kind of a Q&A or a session with you two experts. The central question for the policymakers will be, how do we manage this wave of bankruptcies and unemployment that could spike once forbearance begins to wind down or be used up, and what are the financial support mechanisms that we want to continue, and which ones are going to be withdrawn. So with that, let's get started. I wanted to start with Carmen. Um, is that the right framing? What do you have to add to the framing? I know you created the framing over the years and are concerned about this problem. So it started as a health crisis, but now it's morphing into, or at risk of morphing into, a long-standing economic crisis. So how is this one different from the past, and what should be done differently by people as we go through this crisis? What do we have to do?
So, David, let me expand on some of the, excellent overview that you provided on the corporate side, because the financial problems of the corporates are also going. I'm sorry? Am I on mute? Am I on mute?
Hearing you.
Oh, okay. The problems of the corporate side are going to be compounded by weakness in the financial sector, by also household debt problems, and of course by the sovereign problems. What I'm getting at is, in much of the emerging world, corporates are still very bank centric. And so, the incremental vulnerabilities to the banks is not just coming from a deterioration in asset quality of the corporate sector. It's coming because there's also a deterioration in quality from households. And also, with the surging budget deficits, banks are also buying quite a bit of government debt. Why am I focusing on these things? Because I think a related concern to the bankruptcies and the related concerns to the issues that you raise about the unwinding of the forbearance measures and so on is the issue of credit availability. And so I think, in terms of what to do, I think, that what ISC does in the context of DARP is very representative of the kinds of things we should be thinking about, which is intensive corporate restructuring in connection with restructuring of their balance sheets. That's one dimension. The other dimension, I think we have to go back to bread and butter, better supervision of financial institutions right now, because we do have, I think, an understatement, and you referred to this, of the non-performing loans. And right now, I think what we've seen is a reversal of the trend that we had seen for a number of years, in which, through the Ball agreements, we had seen greater convergence in accounting standards and what defines a non-performing loan and so on. We're seeing a lot of backpedaling on that, a lot of very idiosyncratic definitions. So the point I'm making is, to contribute to the resolution of the problem, we also have to get a better handle on the size of the problem. And I think the regulatory and supervisory side on the financial sector has a lot to do about establishing just how big are the holes in the corporate side. Let me also mention two other things that very quickly. In Not so much in the middle income countries, but certainly a lot of the low income countries, a contributor to the distress of small and medium enterprises is government arrears, which have skyrocketed in many cases. So the government is not paying its suppliers, and that, of course, translates into balance sheet stresses for the corporates, who in turn do not service their debts to the banks. So there's a ripple effect there. That is not so much an emerging market issue. It's more of a low income country issue, but it's one to also watch. And finally, I think, the uh, ensuring that banks do not go into full-fledged credit crunch um, um, is, I think, an issue that has to be balanced against the needs for government financing. In other words, the classic crowding out. Um, Governments are borrowing a lot, which is indeed at the moment meaning that potential credit that could flow to the corporates isn't flowing. Let me stop there.
That's really interesting, Raghu. This is a different crisis from 08, 09. You were involved in, you've been involved in both. How is this one different, and what are the implications for the financial system as a whole? Anything you want to comment on to get us started?
Right. Well, thank you very much for having me, President Malpass, and it's great to be on this panel. I mean, I think you and Carmen have already referred to some of the big differences. First, this is not really focused in the financial sector, at least not yet. It may still come down to that. But in many countries, the problem is in the household sector, in the corporate sector, trying to keep them alive and floating while we're dealing with the pandemic. So it's different in that sense. We also had in the initial phase of the traditional outflow of capital from the emerging markets in developing countries, and the enormous support given by central banks, especially the Fed, reversed that very quickly. So it hasn't been a problem of capital flight thus far. And if anything, it has been money pouring into the emerging markets at this point. So the problems are a little different. But I think from what you've said and what Carmen has said, it is important to recognize that sitting from Washington, looking at what's going on around you get a impression that things aren't so bad, when in fact many of the problems are severe and hidden at this point and will start emerging as we start recovering. It is a K-shaped recovery across countries. It is K-shaped across sectors within countries. It is K-shaped across companies within sectors. So there is differentiation at every level. And the key for policymakers is how to deal with that differentiation to offer, in a sense, a better targeted response. So, I mean, if you think about the corporate sector, going forward, the key is to avoid any undue costs of financial distress, right? You have to make sure that the problems of the corporate sector, whatever real economic problems there are, aren't compounded by the fact that leverage adds yet another layer of problems, inhibiting investment, inhibiting the ability to ramp up once demand picks up, and so on. So we need to essentially take the costs of financial distress off the table. So effectively, countries have to put their corporate sector through some kind of a triage process. Clearly, there are some large companies in reasonable sectors that are doing fantastically, sometimes making the highest profits they've made for a long time because they're they're external facing, they've got fantastic business prospects. They have access to capital. And then there are the smaller ones which may be in that same sector but don't have access to credit. This is the point that Carmen was saying. Access to credit as we come back is going to be very important. Banks should be adequately capitalized, not for the past, not to just absorb the losses, but for the future, to make the loans that are needed to bring the economy back, because many of these small and medium firms are going to be starved of working capital and will need that. And then there is the set of firms that have excess leverage, right? That have been sort of surviving, borrowing more, have gotten some government guaranteed loans, but effectively those are loans, and they have to deal from of excess leverage. Sometimes it can be done through a restructuring process. Obviously, as both of you have said, that restructuring process has to be effective. It doesn't mean necessarily going through the courts. I think Mahesh's section has talked a lot about using the shadow of bankruptcy. You want a bankruptcy process at the end just to get everybody's mind focused. But if you can, you want to do it out of court so that it's simple, quick, and use bankruptcy as just a stamp rather than occupy the courts. So if you can have a bankruptcy process that sort of works, or revamp it so that it works, then a lot of it can be done out of court very simply. And there'll be a lot of negotiation needed, because we have moratoria on rents, we have moratoria on bank payments. All that will have to be renegotiated as we come out. So leverage has to be dealt with. Now, you can bring down the leverage, then you can make these companies able to get credit. Of course, as we come back, we have to also be more clever about credit guarantees. It can't be blanket guarantees; they're really costly. We need the private sector to get more involved in risk assessment, risk management. So perhaps the government, instead of guaranteeing each loan, can guarantee portfolios, can guarantee a certain fraction of the loss, not the entire loss. Allow for more performance pricing in loans, so that as companies get better, they get the benefit of lower interest rates. There's a lot of clever financial engineering that can go into ensuring that the support is targeted and doesn't impose a huge cost on government balance sheets. Two last points. There will be entities that have excess leverage and you can restructure, but even after that, they have too little capital. So capital infusion may be necessary. If the markets are not willing to provide that capital infusion in certain cases, it may be the government that needs to provide that. But the government is poorly positioned to do that. So creating structures, public-private partnerships, where there is a sharing of losses, but the private sector, which has more ability to do some of this, may be in the forefront in leading in equity infusion. That may make sense. And finally, I mean, we have to take hard decisions. There are businesses that will not have a future. They have to be shut down and resources have to be redeployed. Now, the need to do this is both significantly greater in emerging markets and developing countries, which haven't given their firms the kind of support that industrial countries have been able to do, but also the institutions to do this are much weaker. And so this is really a time when, if we can focus on institutional reform is a strong word, but reshaping, so that we are prepared for the period of triage, it will help these countries tremendously, especially because restructuring will involve less resources than sort of the blanket help that is otherwise required. Last point, this will also require making some politically difficult decisions. When you think about financial distress, it's not that small corner restaurant or barber shop which has a lot of organizational capital that needs to be sort of helped. It's the kind of entity that starts up and closes down all the time. If they have access to credit, that should be enough for the small entities. Yes, a number of them will close, but a number will open. Large firms also will have access to the capital markets. Then they don't, if they've got too much leverage, as you said, bankruptcy processes are there and they're actually alive and functioning right now. It's the middle, the small, the medium-sized firms, which are really should be the focus of rescue efforts, because they're the guys who can't get capital easily, but they're also the guys who have significant organizational capital that could be lost if they close down. And that's sort of should be the focus of when we build back. Large can take care of themselves. Small, probably, hard-hearted as it may seem, are not that important except if they're concentrated in a particular locality. But it's the medium where we have to focus. Let me stop there.
Raghu, those were great comments, and I note that you've for people that in the group of 30, you've written or been involved in notes on this one called "Reviving and Restructuring the Corporate Sector Post-COVID," so people can refer to that. And also, you did the Financial Times article back in December that was on this related topic. So I want to ask, I was listening and learning, and I want to ask Carmen, this point that you make, that the middle. So what we tried to do at the World Bank Group back starting in April a year ago was to have IFC finance working capital for its existing customers. So it was a ready provision of credit to known customers that would make it possible for them to stay in business for a while. But then the question is, how do you then have triage among the successful companies versus ones that are not going to be successful, especially in smaller countries? So to Carmen, how does anyone sort this out from the standpoint of when you should wind down forbearance and let some of the companies go under while support is provided for other companies?
Well, in my earlier remarks, I emphasized very much that as a first step, I think the issue, a lot of what we learn about corporates, we also learn through their lenders. And I would note that medium and small businesses in most countries, actually outside the United States, are very bank centric. That even includes in Europe. So I think the scrutiny of bank balance sheets will be very instrumental in trying to sort out insolvency from illiquidity. I think going forward, the model post, if we are going to contrast this to what we should or should not do relative to, say, the 2008 crisis, I think one takeaway lesson from the European, and I very much stress the issue of the importance for small and medium businesses of credit crunches, was if you look at the BIS data post 2008, 2009, by any historic metrics, you have a massive credit crunch going on. What was the source of that credit crunch? Importantly, it was a reluctance to write off pre-existing loans. And that goes to the point Raghu has made that, let's face it, some of those decisions are going to be really difficult because, some of them will involve the issue of fire sales, which we've seen also in previous crises. But the reluctance to not acknowledge losses or not accept that there are sectors that, yes, tourism and hospitality may recover, but it may be in a time frame in which intermediate support is open-ended and very costly. So you have to make the kinds of tough decisions that Raghu was referring to. And I think the first step is recognizing what is non-performing, moving to the write-off stage, and that really does open the pipeline for more credit flowing to the small and medium enterprises. A big takeaway lesson from the 2008-2009 crisis in Europe was that you had a combination, and it's a combination we're seeing here and now again. The combination was an element of evergreening / forbearance with pre-existing loans, many of which were non-performing, and the acquisition whole scale by banks of government debt. That is a classic combination for basically leaving credit to the private sector as a residual. That's a headwind to recovery. And so I think write-offs, I'll conclude by saying that if you look at sort of the resolution, and I know I'm focusing deliberately more on resolution to a financial problems, but they're intimately connected to the corporate problems, except for those, that top tier of corporates that have direct access to capital markets. But a big takeaway from the resolution of previous crises is dealing with write-offs, making the decision of what's insolvent quickly, and that has meant a big difference between your more. I think post crises, these are all U shapes. The question is, how close is the U to a V versus the U to an L? Let me stop there.
No, that's a good point. That in historical perspective, maybe it will be U-shaped, but what we really want is it to be a resilient recovery as soon as we can for a lot of people in the world. We're going to be having another session later in this series that Mari Pangestu is going to chair, that's going to specifically talk about SMEs, small and medium-sized enterprises, and the challenges that they face in trying to get access to credit, inclusion in the credit. But today so one of the things I'm interested in, or we're all interested in, this bigger dollar value picture problem of the middle part of the spectrum. Raghu, you were the governor of the central bank of the world's biggest democracy, and so I'm interested in your views on how the trade-offs can be made. I'll play devil's advocate. From the standpoint of a democracy, it may often look tempting to have the solution be just continue the forbearance, meaning the people that already have loans. Carmen used the term evergreening the loan, so you just keep going with the existing structure, and that in some way makes a lot of people happy. The obvious downside is you don't get creative destruction, you don't get growth into the future and investment into the future. So I know you worked on this a lot in India, and you enacted, or it was during your term, the Insolvency and Bankruptcy Act that has been operating in India. How do you view those trade-offs, and how can democracies, or people working together within their society, how can they ever make the trade-offs that we're talking about?
David, it's extremely important. But let me, since you mentioned that report, I should say that the report, the G30 report, was written by Douglas Elliott and Victoria Ivashina with a team, and my co-chairman on that was Mario Draghi, who's now doing something else. But on this issue,
he's Prime Minister of Italy. Yes.
Small job. But you hit the nail on the head, in the sense that the temptation to forbear, the pressure to forbear, is enormous at times like this. The banks don't want to recognize their bad loans. Obviously, the entrepreneurs who have bad debts outstanding would prefer the bank evergreen them, gives them a chance. Maybe there's some miracle happens and they find their way out of trouble. But being seen as a non-performing asset, etc., is a stigma that they want to avoid. And of course, the government understands it has to recapitalize the banks if the private markets aren't willing to do it. And therefore, the government worries about the hit to its own balance sheet and wants the central bank to go slow, especially if you are a country with significant number of government-owned banks. So really, there's no constituency which is strong, which is pressing for a cleanup. And the constituency whose voice is not heard are those new firms that are being starved of credit because credit is going to the wrong places. Those guys are off. And you can see it in the numbers. India had a problem of NPAs. We tried to get at it. We've made some progress. Of course, the pandemic will create new ones. What you see is when the non-performing loans rise, banks become more and more reluctant to lend. So yes, you can see some lending, but a lot of it is going to, as you said, existing borrowers who aren't the source of new growth. And if you don't resolve the bad loan problem, if you don't restructure, if you don't call a spade, and you don't uh, build new capital into the banks, you will see a slow burning crisis, which eventually will morph into a full fledged crisis. But along the way, it will destroy growth. And that is, I think, the lesson from problem after problem. Deal with it quickly, as reasonably as you can, because burying your head in the sand and hoping it goes away, it doesn't. It just gets worse. And I think that is something that we have to recognize, that all the forbearance, the moratoria, etc., it has to end. If it doesn't end, we're just hiding the problem, and it will come back in to hit us in spades. But you can use the time while you're building some political room to take those actions. You can use the time to ensure that the banks have the appropriate instruments, that you have a revitalized bankruptcy system, etc. Because telling the banks to deal with the system without giving them the tools, uh, telling them to deal with the problem without giving them the tools, is also not particularly clever, because they'll get paralyzed. So you need to give them the restructuring tools, and that is something that can be done right now while we're still waiting for the crisis to ebb.
I'll ask a final question of you both, and then we're going to go to some. Mahesh is going to lead us into a couple questions from the from participants. But so I. Oh, I'm sorry. Go ahead. Right. Uh, uh, okay, so my question to Carmen is, what would, if you think about 2021, what do you think's the most important thing for the world to do, or for any countries to do? So it could be data, transparency of data. It maybe it's technical assistance that can be provided to smaller countries, because they face a giant challenge through their regulatory structures. What do you think's the most important thing for the world to do? And then I'll ask that same one to Raghu.
Um, I think there are three things. They're not mutually exclusive, and the we are still in the pandemic. So I think the issue of large financing gaps are still very much a reality in the crisis mode. So, I think, the financing demand. Raghu mentioned, the comfort that, there was huge withdrawal of private capital during April and May of last year. Some of that has stabilized, but I would note that it has stabilized at a lower plateau. And it's at a time in which, there are, so financing is very important. I think, I mentioned that they're not mutually exclusive. I think restructuring and restructuring in different degrees, right? It's not just about the cases among the sovereigns that we hear about, the Chad or the Ethiopia. I'm not just talking about the sovereign, but restructuring of the corporate sector, as we have been discussing here. Those, not just those that's got into a problem here because they started with a large debt overhang, David, as you mentioned, in your introductory remarks, but those that got into the problem because their industry collapsed, which is the exceptional nature of the COVID shock. So the restructuring at the corporate level and even at the household level. And we're already seeing steps on that in which households are given a longer pipeline to repay debt, basically, extension of maturities. And third, I think the point you mentioned hits it on the nail, technical assistance. Because how do you restructure banks? How do you go back to? I mentioned that for decades, uh, global standards in finance had begun to converge more under the umbrella of Ball, and COVID has done a lot of damage to that. So I think technical assistance, uh, technical assistance in debt management is huge. I'd like to just throw in one thing that we haven't touched on that I think is an important source of risk for the corporates going forward. Look, uh, we have unprecedented. We've focused very much, I think, on the issue of domestic credit, which is a big fuel for corporates and growth in much of the emerging world. But then there's the issue of global capital markets, which have been an invitation to take risk. I mean, the exceptional high liquidity, low interest rates, it's very much an inducement to risk taking. And we've actually seen, if you look at the US alone, the issuance in corporate debt is very skewed towards, low quality, high yield. And I think for governments around the world to closely monitor what their corporates are doing in terms of external borrowing is very important, because we know that what are private debts before a crisis become public debts after a crisis. Witness one of the first things Korea did during the 1997 crisis was to guarantee the external debt of the shareholders. So I think monitoring for the big corporates, the ones that borrow in international capital market, that's a not mutually exclusive from anything we've discussed, but an added cautionary note.
Yeah, great points. And so I think about it, the World Bank Group is trying to work at a country-specific level on some of these trade-offs. And the environment is one, indeed, as you said, Carmen, it's a reach for yield. And so the external environment provides more capital than would normally be available. So I think of it as, at the country level, one of the hardest things for the countries to do is recognize that some of their companies are illiquid and some are insolvent, but you don't know which ones. And what you have to take into account is that the world post-COVID is going to have different industries than pre-COVID. So you can't simply treat it as an illiquidity problem. You really have to find some way within this odd reach for yield or low for long environment to make choices about where the future investments of the country need to be, and no one knows what the exact answer is. So that's what's creating such a hard question on are you forbearing from a regulatory standpoint in a way that will hurt long-term growth, or are you enabling the resilient recovery? And I don't have an answer to that, but what we've tried to do is emphasize that there are going to have to be country-specific answers to that, and they have to take into account that there will be different industries after COVID than the country enjoyed or tried to build before COVID. An obvious example might be that tourism for some countries will be less than it was pre-COVID. So then you need to allow a shifting of assets toward the new industries. Raghu, final thoughts, and then we'll go to other questions. What do you think?
Yeah, very quickly. I mean, I'll stay with the topic of the corporate restructuring. What countries need to do there? Obviously, one can veer far off. I think the first thing, taking advantage of the current financial environment, is raise capital wherever you can. Don't settle for normal levels of capital in the private banking system. Let them be overcapitalized so that there is a reason for them to use that capital in the recovery phase. So if your private banks have access, push them to raise more than they need at this point. I think that's important. I think from the government perspective, also cleaning up your own government balance sheet so you have more resources down the line makes sense. So monetizing government assets. If you want to do a privatization, try and accelerate that right now, because asset prices are nice and high. Don't expect them to be forever high, because there may be a reckoning down the line, especially as we've seen some movements in interest rates and so on. So take the opportunity, use the window, raise resources where you can. Then I would argue that certainly re-examine your legislation for bankruptcy. A lot of legislation is often either interminable or it is focused on liquidation. And really, we have to have something which is more focused on revival and restructuring rather than necessarily liquidation. And re-examining that legislation makes a lot of sense. Re-examining bank powers to renegotiate, etc., makes sense. New corporate structures where there is an element of public partnership need to be revisited. So, for example, a number of countries have sovereign wealth funds which have experience investing
in the middle of a very complicated call.
So these sovereign wealth funds can be repurposed, for example, to investing in along with the government in corporate structures. Brazil has the BNDES. That those could be enlisted in the recovery phase. But countries that don't have them might want to create public-private partnerships to invest in equity where needed, and sometimes, along the lines of what we had during the Great Depression, to essentially park assets for a little while because the assets are trading at a huge fire sale, or perhaps to invest in a concerted way in certain areas which are starved for capital, so even regions that are starved for capital. So I think this is a time when you want to re-examine your arsenal and make sure you have enough to deal with the problems as the recovery emerges. Because I think, as you both have said, the worst thing is to not be able to take full advantage of the enormous wave of spending that is going to happen as we recover.
Great point. Sorry, I got interrupted there by my 12-year-old. I want to go now to Mahesh, and will you guide us through the next phase of this panel?
Yes, and we've had a number of questions come in both through the World Bank Live platform and through Twitter, and I'll try and choose some of the most urgent ones. The first one is for both Carmen and Raghu, and the question asks, in many advanced economies, private equity and hedge funds have continued to play a big role in corporate debt restructuring. Is this a positive or negative development, and is there anything that emerging markets and developing economies can learn from this development?
Maybe start with Carmen.
So, look, I think there's always something to be learned about new forms of restructuring. I would have to say that a key difference, and I think we all have emphasized this in different forms, is that the development of capital markets, are extremely different. And the nature of the restructuring that I've been focusing on in my remarks, importantly also refers to simultaneously the real corporate, and the financial side, the banks. One additional element of restructuring, which we are seeing, I think, in a larger scale in EMs that we hadn't really seen on anything comparable before, that is slightly more akin to what you're asking, is the securitization of bad loans. The securitization of bad loans. I think that, that I think that's one area where, in effect, it may help at some point in capital deepening. But that was sort of I think that's been a technology transfer that we are already seeing in many EMs.
I think it makes a lot of sense to involve whatever expertise you can get. You have to be careful, however, that it is not seen as a direct transfer from the public balance sheet into the private balance sheet. One of the big issues with the Paycheck Protection Program in the U.S. was the worry that some of the money would go from the straight into corporations and then out from the back door into repaying the banks. So effectively, the public sector was taking out the private sector. One of the worries with some of these is really the fact that they, in a sense, benefit excessively from government largesse, and you have to be careful about that. You want them involved, but you don't want to be seen as subsidizing them, especially given the kind of sort of quote unquote reputational risk that might involve. And the problem to some extent is that even if they come in without subsidies, but they make a killing. This happened, for example, during the Korean crisis with a Korean bank, which was taken over by foreign private equity, and it did very well. And the truth be told, there was nobody else willing to support that bank at that time, and they did what was needed. But because they made a huge amount of profits from that, it became, the unsavory side of capitalism. Vulture funds buying low and selling high. Now you can't, absolutely, as Carmen says, you can't do anything about that. But keep that in mind. Keep that in mind that you want anything you do to be as transparent as possible, so that later on you can go back and say, look, we made it open. It wasn't a sweet deal. Anybody could have come in. These guys took the risk. They deserve the returns. Otherwise, you create a more difficult political problem. But I would say at this time, whatever help comes in, bring it in, and especially foreign informed capital. That's extremely important in restructuring. Many of these countries don't have domestic informed capital which can do it, and drawing it in is important.
Mahesh, can I pick up on one of Raghu's points there on the importance of transparency in this, as he was describing the PPP challenges the Paycheck Protection Program in the U.S. side. We faced a similar problem on external debt in the implementation of the common framework, where we want to see the benefit of the benefit of the new money that's coming into countries be shared fairly within the countries. And in order to do that, there needs to be a lot of transparency, because otherwise there's the challenge that that smart creditors will come in and really take most of the benefits into their portfolio. So there's a similar challenge on the external debt side. Back to you, Mahesh.
Thank you all for those observations. The next question is for Raghu. Both you and Carmen mentioned the Asian financial crisis in your remarks. And in the 90s, during that crisis, there were several countries that relied on emergency mechanisms, such as the Jakarta Initiative. We saw this also in other crises in Turkey with the Istanbul approach. Should those mechanisms be introduced this time around, or are there certain triggers we should be looking for before government considers those kinds of emergency measures?
Mahesh, I have to admit, I don't know what the Istanbul Initiative was. Can you explain what that was, and then I may be able to.
It was, rather than taking a retail one-by-one approach to corporate debt restructuring, it was the government using its convening power to bring debtors and creditors into a more structured process that was administered, and where possible, also some funding coming in from the government side.
Yeah, no, I think we should be open to all possibilities. And I think going over the history of responses to see what was successful and what was not, I think is something we should be doing, right now. I do think that take for example, the issue of the high street shop. Uh, that's going to be a big issue coming back, right? A lot of shops have closed, never to reopen. And for the few shops that are still open, there's an issue of, if nobody else is open, nobody's going to come visit High Street. They're all going to go online, and the whole sort of neighborhood gets plummets. This is a situation where you need, almost a collective decision on restructuring rather than a entity by entity decision, because the collective also benefits from, the visits of people to that neighborhood. That's an example of where we have to be a little more creative. That we need to think about, here are situations where it has to be, piece by piece, a piece by piece approach. Here's a situation where we probably need to think on a group basis. And in many EMs, this is this bank lending, but the bank lending is fragmented. And to get that together, maybe you need some ability to convene the banks together in a sort of discussion. And it may be that when you do 3 or 4 of these together, there may be some negotiations which can take place between the banks. Okay, you don't take your security there, and I don't take my security here, and we try and do it better. So I would say this is a time to experiment, because the magnitude of the task that might possibly face us, I hope it's small, but I think it may be quite big in some countries.
If I may come in on this very quickly, I think the issue of the securitization of bad loans, which we are seeing initiatives in this dimension, I think, whether it's done on an institution by institutional basis or whether it's done through a more concerted mechanism, but I think it's one area that will be part of the road out. And, as Raghu was mentioning, look, the Swedish government actually made a killing on a long-term basis from buying distressed assets at the height of their crisis. So, yeah, ultimately, there may be finger pointing and so on, but it's an effective tool. Let's not forget that we now take for granted things like the Brady bonds, but the early stages of that were, commercial bank loans that began to be traded in secondary market at a discount before they became securitized. I think this is, in looking for that silver lining in this crisis, I think this may be, an area that we should really give, a serious effort to how to better structure the securitization of problem loans.
Thank you both for that. We have a number of other questions, but unfortunately, we're coming close to our closing time. I would encourage all of you to connect back into future sessions in the series, and you can find us again on Twitter or here on World Bank Live. And President Malpass, I'll turn it over to you for the final word.
Just want to close quickly with a big thank you to Carmen and to Raghu for a great discussion. The World Bank is, as a group, including IFC, including MIGA, we're looking for solutions at the country level for these problems and recognizing the complexity of them. And so I think the things that we've heard today are directly relevant to the effort. And I encourage those that are listening to think about solutions, and as you have ideas at specific country levels, we try to get input in country platforms and other ways in order to more quickly resolve debt insolvencies and then get the assets back into their most productive use. So to everyone, thanks for joining. We hope to see you again on March 19th for the next session in this series that will be on critical building blocks for reform and restructurings. Thanks everybody. Thanks, Mahesh.